Keith Nelson, Dual City Investments here. I'm going to talk about the current real estate market and what investors should look for, be leery of in this uncertain market that we're facing. We have inflation skyrocketing, the war in Ukraine, and then the Fed talking about raising interest rates all affect the investment real estate market. So what do you need to know? What should you look for to make the best decision you can? Should you sit back and hold on to your cash until the market changes? I would argue that staying in cash with inflation so high, I mean losing 7.5% or more, if inflation is up that high. So, what do you do? What I would do is I'd look for a group or a fund or a syndication that employs a macro strategy, not trying to hit a home run on one single asset, but a better global plan of diversification areas and asset classes. Something they may have strong cash flow. Other properties may have a little bit more upside, appreciation, or value add, but a macro strategy, not just promising the moon on one single investment. A lot of funds and syndications, they have a lockup period for your capital, right? Oftentimes 3 to 7 years. I would look for certain investment companies that allow some aspect of liquidity, where you can get your money out either sooner or take it out with written request in a certain amount of time. We employed this strategy right at the start of COVID, where we were going to launch our second private equity fund with a closed raise period and limit on when assets would be sold off and any profits would be distributed. I didn't want to lock up my capital, and I don't blame investors for not wanting to lock up their capital in such an uncertain market as in COVID, and we don't really expect it now. Personally, we've employed an evergreen strategy where the fund doesn't have a close date, doesn't divest its assets after a certain period of time. We can buy through any market cycle, and what I feel that provides is if interest rates are rising, that means cap rates are going to rise, which should increase cash flow on those assets. So even on paper, if equity is decreased because of raising cap rates and raising interest rates, the cash flow should also raise, right? So you just outlast that market cycle. We'll have higher cash flowing assets, and hopefully coming out of it, we'll have higher cash flowing assets that are also appreciating at a higher amount. So sitting back on the sidelines trying to time the market cycle, probably not the best strategy, but look for groups that you trust their larger strategy, their macro criteria, and look for those funds that offer liquidity, like an evergreen fund where you can request funds out if you're not going to the public market. Vehicles will offer greater opportunities and